You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show.
Oh, it's great to talk with you. Interesting week, to say the least.
Well, stock market frenzy, would that be just a calm way of saying it?
For sure. We, of course, had the U.S. presidential election this week, and the next day the Dow gapped up well over 1,000 points. And there are a few things, Dan, which we'll talk about in a second, but it's brought a frenzy of buying into the market that hasn't stopped yet. When something gaps up to new highs that much, anyone who is watching and gets drawn into buying and trading in fear of simply missing out. If you're a money manager on the sidelines and you're not fully invested and the market gaps up, you must then buy. And that's a professional. So that, type of thing is influencing everyone else to buy. And everyone can remember what happened when Trump became president. The stock market had a tremendous rally after initially actually did gap down on the open the day after the 2016 election, but after that gap down, it just rallied. And in 2017, there's barely any pullback at all. I don't think the Dow fell, it didn't fall no more than 10% in the entire year, and the volatility shrank to nothing. And then, of course, in 2018, there's that so-called flash crash, or the VIX blow up, and the VIX ETFs and the Dow had a sharp pullback in the first quarter, which, interestingly enough, happened just days, maybe it was a week, but shortly after Trump and Congress passed his tax cuts. So the market had a big rally in anticipation to those tax cuts, and now those tax cuts are set to expire next year, and they're going to have to renew them, and perhaps they may do more lower taxes or something. So it's early to say this. Perhaps it's too early to say this, but we could be setting up for a bullish trend or a rally into anticipating when Congress extends and lowers taxes some more, which will have to be next year, not 2 years from now. So that could be partly what's going on, but I would note that what's going up the most in the market are tech stocks of companies that have relationships with Donald Trump. So, for example, Palantir has been soaring, and its owner is Peter Thiel, who is one of the biggest supporters and donors of Trump and candidates like Trump, and is a part owner, in fact, in Twitter and Rumble and all those social media networks that have promoted Donald Trump and acted as an alternative source of information for millions of people. They trust those networks more than the newspapers, more than television, more than anything else just about in their lives. The things they see on Twitter is very important to these people. And, of course, Elon Musk owns Twitter. He's donated something like several $100 million into the Trump campaign. He's got his SpaceX company. It has defense contracts with the government. And, he's poised to benefit, maybe be a part of the Trump administration, even if it's just as a figurehead gift position. He's going to be an important player. You've got Jeff Bezos, who's Washington Post a week ago did not endorse Trump. One of the editors of the paper or the head editor, wrote an editorial endorsing Harris, and Bezos ordered it pulled, and he did that the same day that the head of his rocket company was meeting in Florida with a representative of the Trump administration. And he's congratulated Trump, and Amazon has had a sharp rally. So these companies with and people with connections, and there's, you can find more and more of them, are kind of going up the most. Now, outside that, the easiest way, if you want to play a Trump rally with the idea of playing things that are going to benefit, is just use the Russell 2000. And industrial stocks are doing well too. Banks are doing well. It's expected that the bank sector, may be one of the biggest contributors to the rally so far, because banks heavily weight the S&P 500, and it's expected that the Trump administration is going to pull back or get rid of a lot of the banking regulations that came in after the 2008 financial crash. For example, they're talking about lowering the cash reserve limits that banks have to have, which were increased after 2008. So there's a lot of anticipation of Trump lowering taxes, extending tax cuts, making moves that will favor the banking sector and many companies. So I think that's, if you want an explanation for why is the stock market going up, or the rally, but it's, you should say the rally has accelerated because, frankly, we've been in a cyclical bull market now since the end of 2022 and early 2023. So this is really year two, and it's not going to go on forever. But I can't, point to any sign that's ending this year. And I can only look 6 months out using the charts, indicators I use, and they're not suggesting that the stock market rallies ended or are going to end in that time frame. And we're seeing, frankly, this type of buying into new sectors is what it takes to extend the rally. Everyone can remember the market kind of faltered quite in May and June when these big cap tech stocks, you kind of lost momentum and steam. And then in August, some buying came into defensive sectors. Now it's, spreading. And when you see the Russell 2000, jump and the banking sector jump, that helps the broad market.
How's gold doing in all this?
Well, gold took what I would consider a knee-jerk dip on Wednesday, the day after the results. Gold fell something like $40. Silver fell 4%. Mining stocks took a little bit of a dip too, but those pullbacks all took place after gold hit a new all-time high at the end of October. It really kind of pulled back into the election and then had another sell-off the day after, and it's now trying to stabilize. Gold hit its 50-day moving average, and when I look at the charts, this just looks like a short-term dip to me, and it's probably pretty much played out. So, this could be a good entry point. All that said, I've been owning gold now all year, and silver and mining stocks. So, I'm not like making all these buys because I'm already in for much lower prices, frankly, than where we are right now. But we're probably, I would guess, going to go sideways a little bit the next couple of weeks, and then by the end of the year, early January, be making new highs again, unless it just goes up even quicker, which sometimes that does happen. Now, why did the drop happen? Well, as I said, we were pulling back. It's probably a shakeout in the futures market. We saw something similar take place in early August. And when the stock market does gap up like that, there probably were some people that did some selling in gold or mining stocks and just bought the traditional S&P 500 and Russell 2000 and maybe NVIDIA and Tesla and so forth. But it's important for people to realize that what has driven the gold rally is macro trends that are not going away. Even with Trump coming into office, the U.S. debt to GDP is still going to grow over the next couple of years. Inflation is probably going to return again. The CPI's, the inflation rate has gone back down towards 2%, but it's probably going to, accelerate at some point in the future. I don't know if I doubt we're going to get it below 2%. And then central banks around the world have been accumulating gold. They're not likely to stop accumulating gold. And the U.S. dollar index gapped up on the Trump election news, but it's also come down too today. And the Fed's going to be lowering interest rates this week and in December. So I just think it's a temporary dip, and you look to buy. And also, I think commodities as a whole are going to be good buys for the next couple of years. If you believe that Trump is going to help stimulate the economy, that's bullish for commodities, bullish for copper, zinc, aluminum, and silver, and so forth. So I see this as a buying opportunity. The other thing that also made a drop on the Trump election news were long-term U.S. Treasury bonds. All the TLT ETF, for example, which tracks a 20-year Treasury bond, it had a sizable gap down, and bond prices trade opposite the yields, so that means that the yields on Treasury went up, and that's probably because of that's been a trend that's actually been going on since the Fed even lowered interest rates in September. The bonds are oversold, so we probably should see some sort of a bounce or rally. It could be starting, in fact, today. So hopefully that is the case. But this is a trend I'm going to be watching very closely over the next couple months to see how the next rally in bonds plays out and where interest rates could be headed next year.
We'll have more with Mike Swanson right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, how do you think energy is going to do?
Well, energy, I think, is going to do fine. All year, it's pretty much gone sideways. It's still trading around $70 and $77 a barrel. But the energy stocks also came alive on the Trump news, in particular energy, oil rigging, oil drilling companies. They had big gap ups. I think, coal companies went up. I think across the board, the energy sector is likely to benefit from more deregulation that the Trump administration could bring. And they were a sector that did well in 2017, too.
What's the story for uranium?
I'm not really a uranium expert. It's 64 right now, and it went up to 80-something in February. But to me, uranium is just part of the overall energy complex, which I am bullish on. But in my mind, uranium's like a small precious metal. When I think about the precious metals market, you got gold, silver, and zinc and rhodium. And in my mind, uranium's like rhodium, a small part of the energy complex, and there's a lot more people that are experts on it than I am, because I don't really invest or trade in it.
Are your Robinhood day traders going to come back?
Well, those that are still there are buying. There's no doubt about that. So I don't think they're going to come back like they were a couple years ago. But those that are remaining and never close their accounts out completely, this is the type of rally that will bring some of them in, buy or deposit some more money in their accounts and so forth.
Any way to sum up what's happening right now?
Well, Trump won. People are excited. The market rally is accelerating, and no signs it's going to end this year. So I think that's pretty much good news for most people.
Mike, anything else we should be keeping a close eye on?
Well, I would just reiterate to not ignore the precious metals. And I know there's all this excitement about the U.S. stock market, and for good reason. But precious metals, you probably got a good buy point here. And not only that, they are still necessary investments for a portfolio when the bond market is not going to act like it did before 2020, meaning that it's not in a secular bull market like it was from 1980 to 2020 that helped provide great returns in a portfolio. It's now going to have its ups and downs, and gold is an alternative, therefore, for people to have a portion of their money, instead of putting bonds as their sole safe haven position.
Mike, thank you so much for chatting with us.
Thank you. Great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for Mike or for any of our guests, you can send them to info@HowStreet.com. Our YouTube channel is Talk Digital Network. Find us on X @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.